Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
What the hell is going on in markets? That is the question that we asked this fund manager. Welcome to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
Bryce, I'm very excited for this episode. You are asking the question that we are all wondering. What the hell is going on in markets?
I know, It is confusing. Well, today we are joined by Lukasz de Pourbaix. He is the Head of Strategic Solutions at Fidelity. And as we said at the top, we are sitting down with him to get their view on what is going on across markets globally, because they have an incredible, I guess, research arm across the world.
I was going to say the benefits. You can have a team across the world, boots on the ground, doing the research.
Yeah.
And the benefits of hosting a podcast is that you can ask the people to come in, sit in the chair and explain it all to us without having to hire the boots on the ground around the world. So that's what we're doing today. Because I think if we just take a step back and contextualize this interview, there's been a lot spoken about Liberation Day.
Yep.
But I think really this whole year has been quite confusing because back into 2024, we just saw markets absolutely ripping. Like things were flying. And then they really softened this year, even before Liberation Day, the 2nd of April, when Trump announced his tariffs. But then that was the catalyst for a really short and sharp fall down. It was a week and a half where the US market fell over 15%. Headlines were saying bloodbaths, worse to come. The Australian market fell. Markets all around the world fell. It was a pretty scary week and a half. But it was just a week and a half. And then since then, the US market has recovered. It's up 20% from its lows. It's actually up for the year now. The Aussie market is up for the year. These markets are all back up from where they were before Liberation Day. But the data doesn't seem to reflect the story that the stock market is playing out. It doesn't seem to look as good. And so that's what we wanted to understand. Why is there that disconnect? Why are markets pretty calm when the trade data is pretty bad? Who's right? Who's wrong?
No, you're right, Ren, but I'm not sure if markets are forgetting. We still have 2 dates that are hanging over our heads.
It'd be crazy if they forgot.
I know.
It would be crazy.
8th of July is the end of the first sort of 90-day pause globally for Trump.
Yeah.
And then there's another 90-day tariff reduction pause, I guess, between China and the US. Yeah. So still 2 sort of pivotal moments that could play out. And we return back to the chaos that was Liberation Day.
So look, we're certainly not out of the woods yet, but if we want to know where we are in this vast forest that is markets in 2025, we need to get the experts to help us understand it all. And that's what we're doing with Lukasz today. Before we get into it, we do want to say a massive thank you to Fidelity for sponsoring this episode. Their support helps us keep all of our content free here at Equity Mates. If you want to find out more about Fidelity and their funds and their range of active ETFs available on the ASX, head to their website. The link will be in the YouTube description and the show notes.
Well, with that said, let's go to our interview with Lukasz. Well, Lukasz, welcome to Equity Mates.
Thank you for having me.
As you speak to Fidelity clients, how do you sum up the state of the market today?
I think it's one of caution and one of lack of visibility. And I think really that's been accentuated by what we saw, fairly recently with Liberation Day, so-called Liberation Day, where Trump came out with his tariff agenda. It's been a market where people have been trying to consume, like, what is this going to mean? Where is it going to end up? The goalposts are moving, every day, it seems, with every tweet that comes out. So there's generally a sense of caution and generally a sense of, let's see what comes of this before we make any big moves in terms of investment portfolios. That'd be the general consensus. And I think from a market perspective, markets can handle bad news, markets can handle good news, but probably what markets don't like is uncertainty. And certainly in this sort of year that we've had today, that's really been what the market's been about. It's been uncertainty.
So it's interesting you say uncertainty, because it's certainly what we hear when we're reading about, the trade, and what's going on, and I guess the macro story. But then you look at what's happened since the post-Liberation Day lows, and the S&P 500 is up 20%. Feels like traders aren't that uncertain.
No, and you're absolutely right. So it sort of feels like, you had the Liberation Day, there was a lot of nervousness, the market sold off, I think off the top of my head, roughly 15%. And then, there was a big question mark. Now, is this going to be a sustained period of poor performance, and will we see a leg down again? But what we've seen, as you point out, is a V-shaped recovery, which I don't think anyone sort of would have banked on. But it feels like a lot that has been driven by maybe more hope than reality. The most recent announcement that there's some kind of trade deal with China, and the markets seems to be just reacting on tweets at the moment, in terms of there's some positive news, a tweet sent out, and we're buying hope. And look, we may see this process, tariff process, come through, and we'll get more clarity. But at the moment, there's still a lot of uncertainty. So yes, the market has rebound, but we don't think we're at the sort of end of that journey. We might see a bit more volatility, if anything. And really, it's going to be about what some of this hard data that is going to come through. And because at the moment, what we're sort of seeing is some of the soft data. So things like consumer confidence, things like your manufacturing sort of indices, they are showing some weakness. And so what the market is probably waiting for now is the hard data. And that, by hard data, I'm talking about things like the labour market and so forth. So people are sort of saying there's a lot of noise, and the market's fluctuating on news at the moment, but let's focus on fundamentals, and let's sort of see what the outcome may be and what the impact of some of this soft data slowing down, whether that then comes through in some of that hard data. And I think that's what from a fundamental and investment perspective, what we're really focusing on.
Well, what do you think are some of the key sort of macro forces that are driving the current market? Where do you think that will kind of take us if it does sort of play out?
Yeah, so if you sort of think about there's been two big ones in recent times. Obviously, inflation, seems like that was sort of last year's news.
I know.
But now it's clearly in terms of tariff policy and what does that do to trade. So from a macro perspective, I think the big question marks are trade, and we have seen some softness in global trade. I think the other one will be around the consumer. And certainly if you think about the States, I mean, they're not alone, but the United States, in terms of their economy, what drives their economy is really the consumer and their consumer strength. And what we've sort of observed is that we've seen sort of the top 20%, call it, of the consumer, they're okay. But outside of that top 20%, the remainder, like people are, struggling, right? So there's some of the key themes that I think that will be pertinent in terms of, do we see that consumer continue to weaken? In terms of global trade, what do we see? Does that hold steady or does it weaken? And then the flow-on effect then is, do we then maybe see a bit of a weakness in employment come through? I think from a macro perspective, there's some of the key things that are important. And then look, outside of that, obviously, there's geopolitics which are ever present. But I think it's really about, tariffs. What does it mean? Where is it going to end up? And then the flow-on effects from that.
Well, let's zoom in on the US and China, because that's really where the tariff story is at the moment, and we should stress at the moment. And it feels like the range of outcomes has probably never been wider. On one end, a complete decoupling of supply chains between the US and China. On the other hand, the other end of the scale, some grand bargain between Trump and Xi that brings the economies closer together.
Yeah.
So at Fidelity, you have the challenge of processing these wide range of outcomes, probability weighting them, and then thinking about how they'll affect the stocks that you own.
Yeah.
So how do you go about that process? How do you think about the range of outcomes, and what do you think the probability weighted, what do you think the most likely could be?
Yeah, and it's a good question, because I think there's two sort of distinct ways to look at it. There's the bigger picture, but then there's also from a bottom-up fundamental perspective in terms of what's happening on the ground and what are companies doing in China, for example. And that's where, I guess, from a Fidelity perspective, we are leveraging that deep, I guess, research analyst base that we have located globally. But maybe if we stop from a top-down perspective, absolutely the sort of relationship between US and China has shifted materially. And it's not a recent thing, actually. If you sort of roll back to Trump version 1.0, the first sort of iteration of Trump, we saw obviously tariffs. We saw a lot of narrative around more sort of aggressive narrative between China and the US. But actually that continued. So if you sort of then roll forward to when Biden got in terms of tariffs and so forth, those were maintained. And that was pretty much a fairly bipartisan view of the world that, we're competing with China, and that's the name of the game. And then we've obviously seen that accelerate under Trump version 2.0. And one of the interesting sort of stats that I've or anecdotes that I thought was quite interesting, if you look at trade between the US and China and trade between the US and Mexico, Mexico has actually overtaken China as one of the main trading partners with the US in 2023. And that's the first time since the World Trade Organization China went into the World Trade Organization. I think it was 2003. And that's a function of not just what's happening now, but a function of the last several years where there's been a real reconfiguration of trade routes. It doesn't mean that US and China aren't trading. I mean, the reality is, trade routes have shifted. So some of those Chinese goods are coming in through Mexico, for example, into the US, right? But there's no doubt about it. They're competing. We did see that more recently as well with the DeepSeek AI announcement, where the Chinese developed an AI program which competed with a lot of the leading US innovators in that space, which sort of rattled the market as well. So there's no doubt there's in competition. But look, what I'll sort of say though, while there's competition and so forth, the US and China, more the global economy, it is really intertwined. So while there is this sort of deglobalization sort of narrative there, which is true to a degree, there is still a lot of, I guess, dependencies on both. But there is a reconfiguration. So, one of the interesting things has also been the BRIC sort of trading bloc. So BRIC, the sort of initial acronym, which was, Brazil, Russia, India, China, and South Africa, that's sort of broadened out. That's been growing. You've got sort of, I think the UAE now in there and so forth, and sort of whether that sort of becomes a bigger competing trading bloc with the US, who knows? So look, at a top line, you are seeing a bit of a reconfiguration, a reshuffling of trade. From a bottom-up perspective, though, when we look at companies, we are still seeing opportunities absolutely in Asia more broadly and in China. So if you think about the Chinese market year to date has actually been performing pretty strongly. It's not sort of talked about that widely, but it actually has performed reasonably well. And, about sort of 18 months ago, 24 months ago, you saw a big sell-off. A lot of international money left China. There was concerns around the consumer, concerns around the property market, all valid concerns. However, we are starting to see, China's very much taken a steady approach to policy. And while we're definitely not out of the woods in terms of some of the challenges there, we are starting to see some of those things like the property market starting to show signs of some stability. And so what does that mean? That means from a bottom-up perspective, when you're looking at Chinese companies, when you do get these big sell-offs, everything sells off, right? The good, the bad, and the ugly. And if you can identify those quality companies that actually there's nothing wrong with them, they've got good management, they've got strong balance sheets and a strong earnings profile, then there are opportunities. So I think you've got to sort of disconnect the big picture, top-down things, which are real, absolutely, but then also have a bottom-up perspective in terms of the companies themselves. And I think that's where you got to get your hands dirty and sort of be on the ground and do that research.
So we mentioned earlier that there was the Liberation Day sell-off and then the markets have jumped 20%. And the news and the market's reaction don't seem to align. We're hearing stories of the Walmart, Home Depot and Target CEO contacting Trump and saying there's risks of empty shelves.
Yeah.
We're seeing Walmart and Amazon talk about, adding tariff surge pricing to a lot of their goods.
Yeah.
We're hearing the Port of Los Angeles forecasting, a 33% drop in container volumes coming in from China. Like, there's a lot of news that seems pretty dire.
Yeah.
Are markets too complacent at the moment?
There is an element of complacency, and I think that's sort of reflected in how strongly the markets rebound, where I do think some of that has been based on hope, which we've sort of talked about, is there's a hope that actually, the tariff policies won't be as bad or won't be as severe maybe as thought, that it's a negotiating sort of tactic, which may be the case. It definitely may be the case. But there is a level of, the reality is, we are starting to see some weakness in the consumer, which is real. We are starting to see some weakness in pockets of global trade. And those are the things that, really from where we are in the cycle, if we see a bit of a contraction there, those things are real. So I think there is an element of complacency. I think we've been very much sort of conditioned to buy the dip, and it's worked. But if we do see, some of these things gain traction in terms of consumer deteriorating even further, and then, as I mentioned, employment start to get impacted, then things change, right? Because then there's a sort of risk of actually, we might be at a risk of recession, okay? And I think that's what we're sort of looking for, and we're sort of trying to sort of look through that data and to see whether some of this is more sort of structural in nature. And then if that happens, then it becomes really interesting, right? Because then it really becomes in terms of what central banks do in that scenario. If we do get a slowdown, you're probably likely to see them be a bit more aggressive on rate cuts. And if we do see a material slowdown, then we might be back into sort of quantitative easing territory again, so a lot can change. But look, you've got to be sort of pragmatic and just look through the data, I think, in these sort of environments, particularly where there's a lot of news, because if you're sort of investing based on news, it's an emotional roller coaster, right? Liberation Day, market sells off, you could have sold, and then it's sort of, you've had that recovery, so buying and selling on emotion, you sort of want to sort of steer clear of that.
So I guess specifically, like, what is the data telling us, and how is Fidelity, I guess, building or positioning portfolios to really, accommodate for that?
Yeah, so look, from a broader macroeconomic perspective, and if we look at sort of how we think about things in terms of our multi-asset portfolios that we operate offshore as well. I mean, one of the things we look at, and there's multiple factors. There's no one single sort of source of truth in terms of one data point, but one of the things we look at is something we call the Fidelity Leading Indicator, and it's a proprietary indicator. But if you sort of think about what makes that up, there's a range of things. So we're looking at things like the labour market, we're looking at things like commodity prices, we're looking at things like the consumer, we are looking at things like global trade, amongst other things. And then what that indicator's sort of been telling us at the moment is that we're probably late in the cycle, and that general growth has been sort of moderating and slowing down. That's what it's sort of telling us, right? So, and then if you sort of look at the underlying factors, it's not uniform, but probably where the most weakness has been around global trade. One of the interesting ones of interest when we look at global trade, one of the sort of the metrics we look at is something called the Baltic Dry Index. It's not a brand of vodka. It is actually it is an index, but it looks at global shipping prices. So your big bulk carriers that ship things like coal and so forth. And so what that sort of indicates to you, if the prices are rising, it means there's more demand for shipping. And so that means that sort of global trade is picking up. And conversely, if you see that sort of slowing down, it sort of indicates that there's less demand for shipping and therefore indicative that maybe things are slowing down. So things like that, again, it's not the sort of one source of truth, but the interesting sort of data points that paint a picture.
And what's happening with the Baltic Dry Index at the moment?
So it's actually the most recent read, it's actually softened a bit, meaning that demand maybe has slowed a little bit. It does move around, but again, it just helps you form a bigger picture of where we are in the cycle. Are we in expansionary phase or are we in contractionary phase?
Well, Lucas, we want to zoom out of this moment and think a little bit longer term, and think about, I guess, ask what will matter. So beyond Trump, beyond trade wars, beyond all this noise that we're living through, what are the structural shifts you and the team at Fidelity are really paying attention to that you think are really going to matter for investors and I guess for the world that are perhaps underappreciated by the majority of the market?
I think one that is certainly not making the headlines, but it's certainly a long-term structural trend, demographics basically. So if we think about demographics, particularly in the sort of developed world, if you look at Europe, it's very much an aging population. China has got an aging population. So, that's something that doesn't change things overnight. Obviously, it takes time. But, longer term, it's going to be quite interesting because if you've got an aging population and if you take a sort of linear view of it and population ages, you got less people working. There's already questions around productivity generally. So what does that do to growth longer term, right? And there's obviously, it's not linear, right? There's different things like, whether it's immigration, whether, birth rates, whatever it is, right? But the reality is that is a longer term structural trend that we're facing that, again, it's not going to impact markets tomorrow, but longer term, how we tackle that. I mean, one of the things that has been sort of some people have been talking about is, does AI, for example, play a role? So if hypothetically you've got a shrinking workforce because of an aging demographic, does technology play a role to plug that productivity gap, so to speak? So that's one that's, again, underappreciated maybe. It's not the big focus, but longer term, what does it do? Does it create deflationary sort of pressures on the market longer term? So yeah, it's not something that we're sort of, looking at, I guess, day to day on an investment perspective, but certainly if you take a long-term helicopter view, that's an interesting one.
So demographics is often spoken about in, I guess, the negative say, like Australia's population pyramid is inverted, or like a lot of the Western Europe and America has an aging population. Do they have the tax base to support it? That question is now being asked with China as well, with the effects of their one-child policy now really starting to emerge. I think we saw some stats earlier this year that like their marriage rates are plummeting massively. So, there's some demographic questions there.
Yeah.
That's, I guess, like the negative side of the story. But there would also be a positive side of the story where there's like countries that just have population pyramids that look primed to take off. What are some of the countries that you guys are looking at and you're like, they've got like great working age population, things are going to go here?
Yeah, the most notable one will be India.
Yeah.
If we look at India, it's almost the inverse. A big young population, increasingly higher levels of education, a growing economy, and so forth. So I think it's quite interesting. So that actually massive opportunity, we think, from an investment perspective, because I think if you sort of see that young population come through, and that really then also that sort of shift in terms of moving up, to that, call it middle class type of household and spending increasing, it just really opens up a lot of different investment opportunities. So if you think about things like, for example, banking in India, the rate of credit card usage in India relative to, say, the United States, even relative to China, is still relatively low. As you see that population grow and come through and move up that middle class, you see things like credit card usage increase. So if you're part of the banking sector, that's not a bad thing, right? So from an investment perspective, absolutely, it's not all one-sided in terms of the demographic story. There are absolutely opportunities. I think probably their challenge is a little bit different, whereby how do you ensure that the young people coming through, that actually there are those opportunities within their country, right, in terms of job opportunities and etc. So it's a little bit of a different challenge, but in terms of growth profile, very different, from say, Europe.
A lot of big opportunities in India. We've done an episode on the Fidelity India active ETF, actually. FIIN.
Yes.
I think is the ticker.
Yes.
When you're looking long term, though, are there any indicators or signals that you pay attention to that might be different to just focusing on the shorter term?
Short-term indicators, some of those things that I mentioned, some of those trade indicators and so forth can be short-term. You try to sort of pick up a bit of a trend there. I mean, if you think about longer-term, what is a typical longer-term indicator? Actually, valuations tend to be a longer-term indicator. So if you sort of look at, if you're looking at asset classes, for example, whether it's equities, bonds, or property, whatever it is, right? Valuations on an asset class level, if you look at sort of empirically over the long term, valuations are probably not a great indicator in the short term. They're a better indicator in the longer term. So from an investment perspective, a lot of people look at valuations. What's probably important to recognize is that valuations alone, combined maybe with looking at some of these shorter term, more cyclical indicators, is a good way to look at it. Because, so for example, you could get an asset class that looks expensive on valuations, and you could say, well, it's expensive, should I get out of it? But then if the cycle is still positive, then you could see those valuations hold up quite well. And the US is a classic example, right? For years and years, people have been saying, the US is expensive. but it sort of chugged along, right? So longer term, certainly valuations on an asset class level are important, and more on the medium term to shorter term, some of those cyclical indicators. I mean, if you're looking really short term, then you're looking at things like momentum and things like that.
And just to clarify for people who are wondering what you mean when you say valuations, it's like the starting point of a market, like what the valuation is relative to its long-term average is kind of like a big determinant of future returns?
Correct. So effectively, I mean, ideally you can identify an asset or an asset class that's trading at a discount. So trading belongs a discount maybe to its long-term average, for example. If you can identify those type of assets, but also quality assets, then longer term, again, it's proven that strategy can work. I mean, the challenge is just value alone. You got to avoid just buying those things that are cheap, but they're cheap for a reason, right? So it's about buying things that are cheap, but also that have something fundamental that we see that will drive that growth in the future.
Well, let's turn to how we can put all this information, all this short-term and long-term thinking into a portfolio. And I think for, people like Bryce and I who are just trying to build portfolios for the long term and, trying to navigate all this heightened uncertainty and noise, how can we build resilience into our portfolios?
And I'm going to use a term that's sort of maybe overused and it's not too exciting, but it is diversification. And the reason I say that is if you think about markets in recent years, they've been great. Most people will be pretty happy in terms of how equity markets, for example, have performed more broadly. But if you look at that market performance, particularly in the United States, it's been driven by a very narrow segment of the market. So some of the viewers and listeners might be familiar with the Mag 7 term, which is some of those high-profile tech names, your Apples, your Microsoft, etc. So that sort of part of the market, that mega cap part of the market, has really driven a large part of the market, and that's great, right? Because the whole market's gone up. But when you get a bit of dislocation, which we have seen at times, when the DeepSeek announcement was made, you saw a sell-off in some of those stocks. More recently, we've seen a bit of volatility in some of those names. Then you start to think, well, actually, diversification matters, right? So when the everything's going up, people say, well, what do I need to diversify? It's only once you start to see things get the wobbles where people go, okay, I've got to think about what else is out there. So I think it is diversification, and it's diversification not only across asset classes. So, if you're running a holistic sort of portfolio, how much equities do you have? Do you have bonds? Do you have other things like gold, for example? What does that mix look like? But I think also what we're seeing at the moment is as you're getting more volatility and more divergence in returns, you're seeing a lot of more divergence within asset classes. If I take the US analogy, it's really been, large mega cap names that have been really strong, accentuated by those Mag 7 stocks. As you're seeing more divergence, there's other parts of the market, such as mid-cap stocks, for example, that aren't as heavily exposed to some of those tech names, but also not trading as high valuations relative to some mega-cap names. So I think there's certainly more opportunity to identify, strong sort of parts of the market beyond maybe what's just driven the market in recent times.
Well, you're a cross-asset specialist, so if I'm going to start day one, the opportunity to build the perfect portfolio, how should I think about asset allocation mix? What should that look like?
Yeah, so look, your asset allocation, ultimately it's going to come down to your own individual circumstances, your own risk profile and risk tolerances that you have. So I think that's obviously, that is the starting point. But I think if you're starting from scratch, it is about sort of getting that right mix of how much equity exposure do you have, but also how much, do you have, what role do those defensive assets play, right? Because again, when the market's just roaring ahead in equity markets, people don't pay attention to that defensive part of it. Because why do I need that defensive part of the portfolio? So as you do, and we've seen that at the moment. So bonds are an interesting space where for many years, a lot of investors have maybe said, well, why would I hold bonds? Equities, I'm getting X return from equities. And maybe my TDs are giving me a really good return as well. But as you see cash rates come down, as you see inflation moderate, as you see bond yields become more attractive in bonds as well, and as you see bonds and equities, the relationship between those two asset classes or the correlation become normalized, i.e. become more of a diversifier. Perfect portfolio is one about trying to get the return, but also trying to manage the risk And I think the risk is the one where always doesn't get as much of the headlines because it's not as exciting. But if we are in a period of more heightened volatility, of more dispersion, risk should be a primary consideration. So getting the right mix across assets, but also getting the right mix within asset classes as well. So as I mentioned, things like mid-caps, things like emerging markets as well, again, which probably haven't been a favoured part of the market in recent times. The time will come where we think that will be a nice diversify in terms of the portfolio.
So not leveraged US equities at the moment.
Well, each to their own. I mean, if that's what floats your boat, go for it.
So we've mentioned a number of different asset classes or a number of different sub asset classes. Are there any of that we mentioned or any that we haven't mentioned that in Fidelity's view are offering asymmetric opportunities at the moment?
Yeah, so in terms of asymmetric, that can go two ways, right? Asymmetric to the downside or the upside.
Well, we'll take either. We'd prefer upside, but we'll take either.
But look, in terms of asymmetric returns, I mean, it's hard to sort of say, but I think emerging markets is an interesting one because, as I mentioned, it's probably been more broadly in terms of the consensus view, one that's been, whether it's the institutions or wholesale investors have generally been fairly underweight in recent times, and understandably, right? Because there have been challenges in some parts of the market. We talked about China, but it's not only China. India's gone through their sort of different challenges and so forth. So there's been some challenges in that part of the market. But I think it's always when, we are starting to see some of those fundamentals improve in that part of the market, and valuations on an aggregate level don't look stretched in that part of the market. So, we wouldn't say that you'd allocate your whole portfolio to emerging markets, but it's certainly if you've been underweight, and we've actually our views been that sort of we've moved to a more overweight position generally in emerging markets as we see some of those fundamentals starting to improve in that market. So, yeah, it's always interesting to look at asset classes, I think, that have been maybe underperforming, been a little bit on the nose. It's always worth having a look at. And because as you see, the important thing, I think, the way markets behave, you don't need to see all the data to look good before markets move. You just need to see a bit of improvement. Right. And then you could see a nice little sort of pickup in markets.
Well, if people want to hear more about emerging markets and Fidelity's view, we've interviewed Amit, the portfolio manager of the Fidelity Global Emerging Markets Fund. So people can check that out in their podcast feed.
Absolutely.
FEMX is the ticker. How are you managing cash or liquidity in a portfolio? Like, what are you seeing as the sort of right level of dry powder in clients' portfolios at the moment?
Yeah. So look, from a broader asset allocation perspective, we are sort of underweight cash at the moment. I think it's, if we sort of step back, and cash is an interesting one because from an investor perspective, particularly when you see the markets get the wobbles, right? There's different ways people react. There's probably people that go, well, this is an opportunity. But there's also people that will say, look, I'm nervous. I don't want to lose money. I'm going to go into cash. And usually everyone feels good going into cash, right? Because I'm not going to, it's pretty secure. But I think the challenge is at what point do you actually get out of cash? And that's such a hard call to make. So making a big asset allocation call on cash can be difficult because by the time the data all looks good, it's probably too late.
Yeah.
And you've missed it, right? So, from a cash perspective, we are underweight at the moment. It's always good to have some dry powder, but certainly from an asset allocation perspective, it is a difficult one. You as I said, getting into cash can feel good and you feel warm and fuzzy because you're not going to lose money, but markets can move quite quick. And one of the interesting anecdotes out there is, there's a whole bunch of analysis looking at sort of missing out on, the best sort of 10 days in the market. And I think that one of the studies I saw sort of said that, if you've missed the best 10 days in the market over sort of a 10-year period, it sort of adversely impacted your returns for a typical portfolio by about 50%. And it's pretty big, right?
Yeah.
So I would say using cash as, you have to be cautious. Yeah. Absolutely a good source of funding, certainly good if you're sort of looking to allocate, but using it as a broad allocation is hard.
If you went cash, the day after Liberation Day, and then you would have missed what has probably been one of the best days in the last decade of the 10% in
absolutely
when the markets ripped 2 days later. So,
I think in this environment in particular at the moment where there is a lot of news, there's a lot of volatility, to be honest, making any big move, whether it's cash or, going really long equities or what have you, it's a difficult environment because there is not a lot of clarity, not a lot of visibility, and to your point, markets are just moving very quickly at the moment.
So stay diversified. That's the name of the game.
Absolutely.
Yeah. Well, Lukasz, thank you for joining us. You've given us a lot to think about, both short-term, long-term, and how it all fits into a portfolio. So we appreciate you coming on.
Thanks for having me.
Thanks, Lukasz.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.